Hey friends, hope all is well. This is Joshua Stevens from Community Mortgage. Got a quick mortgage tip of the week for you. This week's mortgage quick tip of the week is about the THDA program, that stands for Tennessee Housing Development Agency Program, and that is available to eligible borrowers here in the state of Tennessee. So, what is it? The THDA program is a down payment assistance program, but to put it another way, in a way that may make it make more sense, it is closing cost assistance. So it is for sure down payment assistance, but suppose that it is going with a loan type where there is not a down payment. That's where it steps in and it can help cover closing costs. So what it does ultimately at the end of the day, the THDA program for eligible borrowers, it reduces the cash needed to close on a house. So now it's like, John, what do you mean if there's a loan type that don't have no down payment? What you talking about? It's a THDA. Here's how THDA works. The THDA program attaches to, or I've heard it said a cool way is it piggybacks, right, or backpacks on with other loan types. So you have conventional loans, rural development loans, FHA loans, and VA, right? The THDA program can go along with any of those. If it's the VA, it's called a THDA Brave, and then for any of the other ones, you just add THDA to it. So it would be a FHA THDA loan, conventional THDA loan. Let's say we're doing a rural development loan, right? Let's say that we're going that, and we're going to also have the THDA component. Well, with a rural development loan, there is no down payment. So since there's not a down payment, those funds from the state come in and they help reduce the cash to close, and they will cover some of the closing costs or all the closing costs. So what is it? How much is it? All that stuff. What it is you got two options. There is a $6,000 down payment assistance where the state will provide the $6,000 to eligible borrowers, and that can help reduce the cash to close. Or the other option is if you qualify, you can get 6% of the purchase price in down payment assistance. So here's the big thing to know about the $6,000 assistance versus the 6%. If you go with the $6,000, you don't have to pay that back until or unless you sell or refinance the property. It's not added to your monthly payment, nothing like that, until or unless you sell or refinance the property, at which time you have to settle up with the state. But if you are working with the 6% down payment assistance program, the way that one works is they do add a payment for that one, a repayment. It's part of your monthly house payment, and you pay that back over the course of 15 years rather than 30. It's amortized over 15 years. Also, about the 6% down payment assistance is that is sometimes hard to arrange. Most often, it's easier to go with the $6,000 option rather than the 6%, because the 6%, you're paying that one back, right? So that figures into the debt to income ratio. There's a link in the description below to the last video I did about the debt to income ratio. So the thing it is whatever 6% of the house is, we're adding that to your borrowing amount, right? So that can sometimes be difficult to arrange. But in these circumstances where I've been able to do the 6% down payment assistance, it's really cool because that puts the borrower bringing like little to nothing to close. Again, it's difficult to arrange, but it is possible and largely dependent upon the debt to income ratio. It's a great loan program. I'm a big fan of it. I use it all the time, and it does a really great job of helping folks get in houses. So, Josh, all the nerd stuff, great. How do I know if I'm eligible? In order to be eligible for a THDA loan, there's a couple parameters. First one being, you need to be a first-time homeowner. Now, the THDA program defines a first-time homeowner as someone who has not owned their property in the past 3 years. So, if you owned a house 5 years ago, but you have not owned a house in the past 3 years, you could qualify as a first-time homebuyer. The other qualifying factor is the location. Depending upon the property location, it could be in an area that THDA deems as a target area. And if the property is in a target area, you do not have to be a first-time home buyer. And there are sometimes instances where entire counties can be considered these target areas where you do not have to be a first-time homeowner in order to use a THDA loan in that area. The best way to figure that out, just give me a shout. We'll look it up and see if it is in one of the areas where THDA says, nope, you don't have to be a first-time home buyer to purchase this property. The other thing to know is there is an income limit. It's an income-driven program, so depending on the number of people in the house and how much money the people on the loan make, you can be qualified or disqualified. If you make too much money, it will throw you out and you will not be able to be eligible for a THDA loan. One more thing about the THDA loan, the required minimum credit score is a 640. So these are the big things to know about it for eligibility purposes. Am I a first-time home buyer? And if I'm not a first-time home buyer, Is the property I'm interested in a targeted area to where that homebuyer rule, first-time homebuyer rule, does not apply? The next thing, I got to have a credit score of 640 or over. And the other thing is I can't make too much money. I can't make too much to qualify for the program. Friends, that is the Mortgage Quick Tip of the Week. Remember that everybody's personal situation is unique, every property is unique, and therefore every purchase process is a little unique. Give me a shout and we'll review your situation and see how the rules, laws, and loan programs are applicable to you and how we can best chart a path forward. If I can be of assistance in any way, feel free to give me a shout. Take care and have a good one.